the next topic will be Module 4, Liquidity and Interest Rate Risk Management. So let us start with the liquidity risk management. And during this lecture, we will explore liquidity coverage ratio and net stable funding ratio. The metrics are the most important in the liquidity risk management measurement. Therefore, they were recommended actually by the Basel Committee of the banking supervision just a few years ago, and they were implemented by the Russian banks, for example, and the banks all over the world. So let's talk about the liquidity risk management and its concept and definition. So first of all, as you may understand, the liquidity risk management is very crucial for the banks because it ensures they can meet all of the obligations. In general, there are three main types of liquidity risk we need to consider. The first one is physical liquidity risk. This is inability to meet obligations due to the lateral lack of the funds. Then goes normative liquidity risk. So that means failing to comply with regulatory liquidity ratios set by the central bank. Then goes structural liquidity risk, which is the possibility of significantly worsening liquidity due to mismatches in assets and liabilities. And the core object of liquidity management is to ensure the bank can unconditionally meet all obligations while complying with regulations. And this is challenging really because liquidity risk can arise from various sources. For example, assets may grow faster than liabilities. And in that case, large loans being disbursed or deposits withdrawn simultaneously or around retail deposit performs or losing access to funding markets occurs. So these are all possible causes of the liquidity crisis for the bank. As we go through the presentation, through the lecture, please keep in mind that these risks manifest how the bank worked to mitigate them through careful liquidity management. So now let's look at two key approaches to liquidity management, which are top-down and bottom-up. And these complement each other to give a comprehensive view on the liquidity risk management. So the top-down approach focuses on long-term strategy. It looks at the 1 to 5 year horizon usually and defines target states and major steps to achieve them. And we have to think of this as setting the overall direction. In contrast, the bottom-up approach is about short-term tactical planning. Usually it looks at a horizon of less than 3 months, and usually it focuses on specific steps to take at each point. And this is about day-to-day or intraday liquidity management. And to illustrate this, imagine that, for example, we are planning a cross-country road trip. So the top-down approach would be mapping out our overall route and major stops, and the bottom-up approach would be, for example, planning each day's driving, where to get gas, etc. Both of these approaches or perspectives are very crucial. For example, the top-down approach ensures that we are moving in the right direction strategically, while the bottom-up keeps us on track operationally. The next slide is available liquidity volume. So let's dive into it. This usually represents the resources a bank maintains to ensure normal operations and respond quickly to liquidity pressures. So we can break this down into two main components. The first one is liquidity reserves. Liquidity reserves are usually liquid assets on the balance sheet that can be directly used to quickly sold to meet obligations. Yeah. We can think about it as our readily accessible cash and near cash assets, for example. And the second component is operating liquidity reserves, which is the volume of funds the bank could potentially raise in the short term to meet obligations or to improve liquidity ratios. And we can think about that as our credit line or assets we could quickly borrow against, for example. And for liquidity reserves, we are looking at things like securities acceptable for repo, repurchase agreements, loans under specific regulations, nostro account balances, and short-term loans to other banks, for example. And for the operating reserves, we can consider options like direct repo with the other banks for sure, and currency swaps, for example. Finally, the key here is understanding not just what immediately available, but what could be quickly accessed if needed. So this gives us a more comprehensive view on the bank's liquidity position. So the next slide. Now let's talk about two critical metrics for assessing liquidity risk, which are the liquidity gap and the survival horizon. So what are they? First of all, the liquidity gap represents the difference between cash inflows and outflows over a specific period of time. And it tells us if we are running a surplus or deficits of the fund. So if we look at the graph on the slide, so the bars show net cash flows at different time periods. So when they are above the line, so we have a surplus. And below the line means we are in a deficit. And cumulative gap shown by the line here is the total liquidity deficit or surplus up to the point of observation, for example. And it's really crucial because it shows our overall position over time. And now we have to define the survival horizon as the key measure for the liquidity analysis and stress testing of liquidity, for example. And it's really the point where our cumulative gap becomes zero. In other words, how long we can survive in a liquidity crisis. And in this example, you can see that our survival horizon is about 2 months. So it's where it crosses zero, actually, the point 3. It pointed red. So that's how long we could meet all obligations without additional funding. And when we manage liquidity, we are always trying to extend this survival horizon. And it's in other words, it's our buffer against unexpected events. This is just, by the way, isn't just about avoiding crisis. So because a strong liquidity position also gives us usually flexibility to seize opportunities in the market. Therefore, this is about liquidity gap and survival horizon. But the very general amount or survival horizon level is for about 3 months for 90 days, calendar days. So let's now break down the sources of liquidity risk. And it is really crucial indeed. So first of all, we can categorize these into bank-specific or internal sources and market-specific or external sources. So on the bank-specific side, we have, first of all, call risk. This is about unexpected cash outflows or the bank run, so-called, like deposit redemptions or, for example, credit facility drawdowns. Then goes term risk. So this involves delays in expected cash inflows. Then goes downgrade risk. So because if the bank's credit rating is downgraded, it might face a funding squeeze or higher borrowing costs, for example. Then goes product risk, because some assets or liabilities might only be sold or bought with high markdowns. And on the market-specific side, we can look at the market liquidity risk first of all, because this is the risk of not being able to sell assets at fair value, at fair price, due to market disruptions. And overall, these risks affect both short-term or tactical or operational and a long-term or structural balance sheet liquidity. Therefore, as we manage liquidity, we need to consider all of these sources. And it's not just about having enough cash on hand, but also about understanding and mitigating these various risk factors. And in practice, a bank might face, for example, multiple of these risks simultaneously. And this is very robust risk management. Crucial is needed, is necessary. So the next slide. Now let's explore three key approaches for a quantitative framework for the liquidity risk management and assessing liquidity risk. Each of these approaches offers a different perspective and level of sophistication. The first one is balance sheet liquidity. This is actually the simplest approach. It looks like the relationship between different balance sheet items, first of all. And for example, comparing loans and receivables for non-bank deposits and certified liabilities may be an example of that kind of liquidity. And further on, it's rather straightforward but limited by content rules. The next one is maturity mismatch approach. And this approach is much more complex. Why? Because it maps inflows and outflows on a maturity ladder. And it consists of the factors like residual maturity of loans, for example, liquidation periods for securities, behavioral patterns for non-maturing accounts, for example. And really, this gives us a more dynamic view of liquidity over time. The next one is cash capital position. And this metric measures a bank's ability to fund its assets on a fully collateralized basis. Because it's about ensuring actually the bank can conduct business for a survival period, even if unsecured funding becomes unavailable. As we move from balance sheet liquidity to cash capital position, for example, we can gain more sophistication and accuracy, but also more complexity for sure. And in practice, banks often use a combination of these approaches, for example, to get a comprehensive view of their liquidity position. So we have to think about these things and go on. So if we dive deeper into the balance sheet liquidity approach, so we can say that this method is about assessing the quality of the balance sheet in terms of liquidity. On the asset side, we are looking at loans, receivables, investments, for example, trading assets, reverse reports, and security borrowing. And on the liability side, we have non-bank deposits, unsecured bank deposits, trading liabilities, certified liabilities, for example, senior or subordinated or repos, and the others, and equity, for example. The idea here is to compare these different categories to get a sense of the bank's liquidity position. For example, we might compare loans and receivables for non-bank deposits and certified liabilities as well. And this may give us an idea of how much of our longer-term lending is funded by stable sources. So therefore, this is a key. And further on, the main advantage of this approach is its simplicity. Why? Because it's easy to calculate and understand this. However, it is very important to know that this method is driven by accounting rules, which are not necessarily liquidity or about the liquidity. Some assets, for example, might be liquid but not appear so, for example, on the balance sheet and vice versa. And so this is why we often use actually this approach in conjunction with the others for more complete picture. So the next slide. Now let's look at the cash capital position approach in detail. The truth is that this is a more sophisticated method that usually focuses on the bank's ability to fund its assets on a fully collateralized basis. And the key question here is if we lost access to unsecured funding, could we still fund our assets, for example? On one side, we have collateral value of unencumbered assets. Liquid assets, for example, contingent funding capacity. And on the other side, we can have short-term funding, non-core deposits, core deposits, long-term funding, equity, for example, contingent outflows. And the difference here between these points is our cash capital position. Then this approach has an advantage of being quite intuitive, and it gives us a clear picture of our funding resilience. But on the other hand, it doesn't give us specifics about the term structure of our funding, because it's some kind of the snapshot. That's not a dynamic view over time. And in practice, this approach is often used to set a minimum cash capital position as, for example, as a risk limit. It helps also to ensure we always have enough stable funding to cover our liquid assets. So that is about cash capital position. So the next one is maturity mismatch approach, which is perhaps the most comprehensive of the three methods were discussed. And it gives us a dynamic view of our liquidity position over time. That is a difference. Here, the key issue of this approach is mapping all of the flows into the time horizon. For example, we typically can look at the both short-term horizon, like for example 8 weeks, and the longer-term horizon, like for example 18 months. And in general, this approach allows us to see potential liquidity pinch points in the future. And for example, we might see that we have adequate liquidity for the next 3 months, for example, but potential shortfall after that. So this is, in general, this is a powerful tool for both tactical and strategic liquidity management. We can use it to set limits, plan funding, and even stress test our liquidity position. So as we delve into the liquidity modeling, it is crucial to understand the various sources of liquidity and how they behave. And financial innovation of the banking business has made it increasingly complex indeed. So we need to consider three key dimensions of cash flow. The first one, amount. So is it known, for example, like contractual flows on a non dependent on factors like collateral calls or purchase amounts? So that is a question. So and there is a difference in assessing the liquidity risk according or due to that issue. The next component is pay date. So the question is it fixed or flexible? And there is a difference as well. So the next one is cash flow type. So is it deterministic like loans or bonds, or modeled, for example, like savings accounts, or optional even like credit line drawings? So that is a question. And overall, in general, these dimensions interact in complex ways. For example, a structured product might have an unknown amount, an unknown pay date, and be an optional cash of the optional cash flow. And we also need to consider so-called self-refinancing assets. So, for example, those eligible for central bank operations or repo transactions. And all of them have different liquidity characteristics as well. And the challenge here is to model all of these different types of cash flows accurately, because we need to capture both contractual and expected flows, usually. So if we talk about the liquidity runoff profile, or LRP, so we can say that LRP is essentially a map of all our future cash flows, both deterministic and modeled. It usually includes assets, liabilities, and off-balance sheet items. And we can use this tool in two main ways. First of all, for situational liquidity risk management, like, for example, liquidity cash report in the liquidity cash report, and the second one for structural liquidity risk management. The liquidity cash report here is our short-term view on the liquidity. It's usually updated daily. It is very granular, and it looks out about 250 days. And this is what our treasury, for example, treasury team uses for day-by-day management. And the liquidity gap report, as well as our long-term view. So there is a difference: liquidity cash report and liquidity gap report. Yeah, I would stress your attention on. And the liquidity gap report is our, in other words, long-term view. It covers all the maturities, and it's used for business planning and strategic decisions. Both of these approaches are usually derived from the same underlying data, which is our complete liquidity runoff profile. We also, in the banking, we also use this data for the other crucial risk management tasks, for example, like stress testing and contingency planning, like sensitivity analysis, and like back testing. As I said before, the LRP approach is very powerful one, as it gives us a comprehensive view on our liquidity position. And moreover, it allows us to see potential issues far in advance and take corrective action. So let's go on. Now let's break down how we actually calculate our expected liquidity profile. And this is actually a multi-step process. and it combines various types of cash flows and assumptions. So first of all, we usually start with the deterministic cash flows because they are contractual flows which with non-terms and maturities. So then we add modeled cash flows for products with undefined maturity profiles, like saving deposits, for example. Then we factor in optional cash outflows like drawdowns on credit lines, for example. Then we also consider optional cash inflows like immediate lines from the other banks. And we apply behavioral assumptions to adjust these flows based on expected behavior. And finally, we add in planned new assets and new funding. This results of step 1 to 5, and it gives us our liquidity risk view in overall. And in general, this is a basis for our risk limits. Then we can add in step 6, we can get our expected liquidity risk view. And this is what, for example, Treasury uses for activities and performance measurements. In general, it is crucial to understand that it isn't just a static calculation, because we are constantly updating our models and assumptions based on the new data and market conditions, for example. And because of that, this is a multi-step approach, and it allows us to see our liquidity position from different angles. So we can isolate the impact of existing business, new business, and behavioral factors, leaving, for example, just contractual cash flows. So, and vice versa. So now let's talk about the 2 key regulatory ratios introduced by the Basel III for the first time. They are liquidity coverage ratio, or LCR, and the net stable funding ratio, or NSFR. So first of all, the LCR is about short-term resilience, because it requires banks actually to hold enough high-quality liquid assets to cover net cash outflows over 30 days, for example, in a stress scenario. And here, the requirements to this ratio is to be over 100%. And there are several key components of the LCR. For example, high-quality liquid assets like cash, central bank reserves, government bonds, etc. Then cash outflows, like, for example, simulated outflows from deposits, debt repayments, and etc. And cash inflows, like, for example, expected inflows over the next 30 days. And for the NSFR, net stable funding ratio, on the other hand, it is about long-term structural liquidity, because it requires banks to have stable funding in place to cover their long-term assets, usually, and this ratio also needs to be over 100%. What are the key components of the NSFR? They are usually available stable funding, like long-term liabilities and equity, required stable funding, like, for example, long-term assets that need stable funding. And all of these 2 ratios are complementary. For example, the LCR ensures short-term resilience, while the NSFR ratio promotes long-term structural stability. So, and here it is important actually to know that these are minimum standards, because many banks aim to, for example, maintain buffers above these levels. And this is very common. Commonly used approach. But nevertheless, managing these ratios is now a key part of the banking liquidity and funding strategy. Yes, because they influence decisions on asset composition, funding mix, and even product design. So here on the slide, you can see the general formulas for these two components of the or metrics of the liquidity risk management, as we described them before. So the next slide, let's consider the dips of the liquidity coverage ratio here. As I said before, this is a key regulatory metric which was introduced after the 2008 financial crisis, just to ensure banks have sufficient short-term liquidity. And the LCR is defined as a ratio of high-quality liquid assets to net cash outflows over 30 days, and it must be at least 100%. High-quality liquid assets are assets that can be quickly and easily converted to cash. So they must be able to be collected within a day, usually, and they must be easily realizable or usable as collateral. And net cash outflow is calculated based on a stress scenario defined by the regulator, because it considers, for example, things like deposits, outflows of the deposits, changes in collateral requirements, drawdowns on credit facilities, for example. And therefore, LCR is calculated in multiple ways. First of all, for example, multi-currency LCR, it considers both, for example, original or native currency of the bank and foreign currency assets. The native currency, for example, the ruble LCR, it is for sure calculated only for ruble assets. And total LCR, it is calculated for the assets in all foreign currencies, for example. And LCR for different currencies is calculated separately for each significant foreign currency. So a foreign currency is usually considered significant if liabilities in that currency are 5% or more of total liabilities. And I would say that this multi-faceted approach ensures that we are managing liquidity risk across all currencies we operate in. And usually it prevents hidden risk from currency mismatches. So the LCR, therefore, is some kind of the stress test of the liquidity of the bank, because it assumes a combined idiosyncratic and market-wide shock, which means that we need to be prepared for severe outflows. And getting back to the practice, so we can say that managing the LCR involves also careful balance sheet management, because we need to maintain sufficient high-quality liquid assets without sacrificing, for example, too much yield. So Basel III doesn't just give us the LCR. It also provides us a set of monitoring tools to help regulators, for example, to get a comprehensive view of bank liquidity profiles. Let's look at these tools. First of all, contractual maturity mismatch. These maps actually all cash flows from on and off balance sheet items into defined time bands, which are therefore based on their maturities. And it gives a clear picture of potential future liquidity gaps. Then, concentration of funding. This usually helps identify significant sources of wholesale funding. And the key idea here is to flag funding sources that, if withdrawn, then they could trigger liquidity problems beforehand. Then unavailable, unencumbered assets. This looks at assets that could be used, for example, as collateral in the secondary market or for central bank facilities. In general, it's about understanding our potential to raise additional liquidity if we need it. And LCR by significant currency is very important as well, as I said before, because it's calculate the LCR separately for each significant currency and helps identify potential currency mismatches in short-term liquidity. Then market-related monitoring tools are very important because they mean early warning indicators based on market data, for example, and they could include market-wide information, financial sector data, or bank-specific information, for example. So all of these tools overall give regulators a multidimensional view of the bank's liquidity position. Because they are designed to catch potential issues that might not be apparent from the LCR alone. And for the bank itself, these tools are also valuable for internal management because, for example, they help the bank to identify potential vulnerables and areas for improvement in its liquidity profile. So, therefore, implementing the LCR isn't just the technical exercise because it comes with several strategic and operational challenges. So, and let's discuss 5 key ones. So, therefore, unfinished regulation and moving targets. So, the regulatory landscape is still evolving. Actually, because of that, the bank needs to work with different assumptions and maintain flexibility in its approach to the liquidity measurement and management. So here, monitoring international trends might be crucial, for example. Then a monthly daily reporting, because while official reporting is monthly, usually, the bank needs daily compliance and steering as well, because this requires actually new data sources and reconciliation processes between daily and monthly reporting, for example. Then data availability. So LCR calculation here requires combination information from various sources. And the bank needs to identify strategic data sources, for example, with high coverage and verified quality. And in overall, balancing between daily and monthly data updates is crucial here for the bank. Then LCR steering. The front office of the bank usually needs timely information about LCR and NSFR and their contributions into the liquidity measurement. And here the bank needs usually a transparent front-to-back calculation process and the ability to do preview calculations, for example. And the next one is change in roles and responsibilities. For example, when we implement LCR, it often leads to shift the organizational responsibilities. For example, the bank in that case needs to design a target picture early, allocate responsibilities accordingly, and discuss limits and cost allocation for the liquidity buffer. So it is very important as well. So, but overall, these challenges or issues do require a holistic approach. It's not just about meeting the regulatory requirements, but it's about more about integrating LCR management into the bank's overall liquidity and funding strategy. So, but as the bank worked through these challenges, so it it will likely need to make changes to its IT systems, reporting processes, and even to its product offerings. So, what for the net stable funding ratio? Let's turn attention to it. As we discussed before, this is the second key liquidity ratio introduced by the Basel III. So the NSFR comes into effect from or came into effect from January 1st of the 2018. And its purpose actually initially was to ensure banks maintain a stable funding profile in relation to their assets and of-balance sheet activities. And the formula of this metric is very simple. So it's available stable funding divided by required stable funding, and it must be greater than 100%. And here, available stable funding includes usually deposits from individuals and legal entities, external market financing, the other liabilities, share capital, for example. Required stable funding therefore covers here loans to legal entities and individuals, investments in securities, and off-balance sheet liabilities and other assets. So the key here usually is stable. So because the NSFR is designed usually to encourage banks to rely more on stable long-term funding sources. This ratio complements to the LCR, as it was said before, because while the LCR focuses on short-term liquidity up to 30 days, the NSFR, on the other hand, looks at the structural balance between long-term assets and liabilities over a one-year horizon. In general, implementing the NSFR may require significant changes to the bank's funding strategy, for example, and it might lead to increased issuance of long-term debt or changes in loan pricing to reflect the cost of stable funding. Here, as we prepare for the NSFR implementation, the bank needs to consider how it will impact its business model, product offerings, and overall balance sheet strategy, for example. So now we have come up to the first question of the lecture, which is what is the primary purpose of the liquidity coverage ratio as it was introduced by Basel III. So please write in your answers to the chat. And so I will give you a couple of minutes for that. So I can see your answers. 3, 3, 2, 3. Yeah. So the right answer is 3. Actually, please give your answers in the chat because I will track your activity afterwards, after the lecture. The correct answer is 3. Indeed. Why? Because as we said before, the liquidity coverage ratio is designed to ensure banks have enough high-quality liquid assets to cover net cash outflows over 30 days in a stress scenario. And this is actually explicitly stated in the next in the text discussing Basel III liquidity ratios. Therefore, it is very good. Yeah. So if you do not have any questions, we can go on. So the next topic will be liquidity stress testing. Let's try to examine this topic from the classic case study of liquidity risk materialization, I would say, which was, for example, on the example of the collapse of Northern Rock Bank in 2007. So a long time ago. This actually serves as a powerful real-world example of how urgency transformation can lead to severe liquidity issues. So, first of all, let's look at the Northern Rock balance sheet structure. They had a very significant maturity mismatch. First of all, over 75% of assets had maturities over 5 years, while over 70% of liabilities were short-term, just under 3 months of maturity. So this extreme maturity transformation left Northern Rock highly vulnerable to funding shocks. And when the financial crisis hit in 2007, they faced a perfect storm. Because customers' distrust led to a bank run, so very well-known effect of the banking crisis. Wholesale funding markets froze, therefore cutting off their main financing source, and with no other options, the bank had to be nationalized. So the takeaway here is very clear. Over-reliance on short-term funding for the long-term assets is a recipe for disaster. All of the risk managements in every bank. Nevertheless, there were so many cases, very similar cases, for the other banks even afterwards. So the risk managements of the banks must ensure robust liquidity buffers and diversified funding. So now let's discuss the fundamental principles of liquidity stress testing here. In general, there are two key aspects. Those I want to highlight. First of all, we rely heavily on economic and mathematical modeling tools here because this allows us to quantify risks and protect outcomes under various scenarios. But you should remember that models are only good at their assumptions, because of that, risk management usually must apply here critical thinking. And the second thing is very crucial, because risk management here, due to that, have to continuously adjust their methodology to reflect change in macroeconomic conditions. And therefore, it is due to the fact that financial landscape is very dynamic, and therefore, the performed stress testing must evolve accordingly. In my experience, for example, many banks falter by using static models that usually grow outdated. Because of that, risk managers must stay vigilant and reassess their assumptions on a regular basis. So, first of all, let's discuss the time horizon for the stress scenarios purposes. Usually, risk managers in the bank use a 6-month projection period, which usually strikes a balance between short-term shocks and longer-term impacts. The analysis here might be quite granular in the near term, for example, or must be granular in the near term. And then the risk management of the banks calculate the liquidity buffer and gap on the daily basis just for the first month, which gives a detailed view on immediate pressures. For the months from 2 to 6, banks usually shift to weekly calculations for their regular stress tests, because this allows them to capture medium-term trends without getting bogged down in day-to-day noise. Then the banks usually stress test their balance sheet against their business plans, and they use monthly for that purpose. we use usually monthly intervals for the full 6 months, which aligns with how they typically create financial projections. And honestly, I found this tiered approach invaluable, actually, because as to my opinion, it lets us focus intensively on near-term risks while maintain a broader perspective on long-term vulnerables. So now let's talk about the often overlooked aspect, which is cash liquidity stress testing. Because this is actually distinct from overall balance sheet liquidity. Here, the bank's core assumption might be that the cash levels at the stress date are sufficient for immediate counterparty settlements, because this covers the time actually needed to obtain additional cash from the central bank or foreign counterparties. And essentially, the banks stress test non-cash liquidity, assuming cash needs are met, and these may seem counterintuitive, but it allows the banks to focus on broader funding and market liquidity risks, for example. And therefore, in my experience, many banks may fixate on physical cash levels, while important, the real systematic risk often lie in wholesale funding and marketable securities, for example. And therefore, their general approach usually doesn't ensure they do not miss the forest for the trees, as we said. So now let's dive into how the banks account for payment flows in their stress tests. This is really critical for accurately projecting liquidity under stress. As we start by, for example, incorporating all contractual flows from transactions that haven't yet settled. This gives the banks a baseline of non-cash movements. Next, we can project flows for major balance sheet items and off-balance sheet commitments, for example, and we have to do this for each relevant currency, applying stress scenario parameters. And for each time interval, we usually calculate the cumulative liquidity gap, which shows us where potential shortfalls might occur. And if outflows exceed inflows, then we usually have a liquidity deficit. And then, therefore, we can use our liquidity buffer to cover this gap, or conversely, if inflows exceed outflows, we have a surplus that boosts our buffer. So now let's examine the how we calculate the liquidity buffer, which is really crucial for withstanding stress events as well. At the end of each time interval, we usually assume up three components. The liquidity deficit or excess in the interval, then changes in the buffer due to maturing transactions and securities, and then the buffer at the start of the period. So in this, or if this sum becomes negative, it means that we have exhausted our liquidity buffer and we can't meet our obligations. So the period where the buffer remains positive here is our kind of survival horizon for that scenario and for that currency mix. So now let's talk about the how we can incorporate stress testing in our business planning process. Actually, this is where risk management directly informs strategic decision making. First of all, we plan the liquidity buffer in terms of its constituent items, for example, aligned with our business plan currencies. And here, our goal is usually to determine the optimal buffer structure that, on the one hand, minimizes cost while meeting, on the other hand, all the constraints. And we usually use an optimization problem to achieve this. For example, according to the formula on the left of the slide. So this may look complex, but it's essentially balancing cost minimization with insurance efficient liquidity across various components and currencies. Actually, I found this approach incredibly valuable because it forces us, for example, the risk management at the banks to think critically about the trade-offs between liquidity, safety, and profitability. Because it's not just about having a big buffer, but it's more about having the right buffer composition for our specific risk and business model. So now we have come up to the break, I believe. So let's do a break for 10 minutes until 15 o'clock. Okay, we get back. So do you hear me well? Do you see the presentation? Please write in the chat. Yeah, great. Thank you very much. So let's go on. Okay. In terms of the liquidity risk stress testing, we usually have three typical scenarios. First of all, the market risk or the market crisis, which stimulates a severe, for example, as an example, can stimulate severe downturn of Russian and global financial markets. For example, we can base the parameters on the 2008 and 2009 global financial crisis. Then the second scenario may be devoted to the name crisis. And it models a bank-specific crisis of confidence, usually. For example, we can derive parameters from events similar to 2014-2015 period. And the last one is maybe a combined crisis. This is usually the most severe scenario, combining the worst elements of both market and name crisis. So, and I would stress your attention that using multiple scenarios is really crucial here, because, for example, in my experience, single scenario tests often lead to blind spots, so-called, I would say. And by examining a range of potential stresses, so we can identify vulnerables that might be missed in a narrow analysis. So, but you should remember here that our main goal isn't to predict the future. Our main goal here is to ensure we are prepared for a wide range of potential challenges. So, the next slide. Now let's delve into the specific of the weekly stress tests of the bank, of the typical bank. For example, a typical bank can analyze the contractual liquidity gap for several key items. For example, first of all, interbank market activities, both borrowing and lending, then securities portfolio, then loans to legal entities and individuals, and then individual deposits, like, for example, treated as overnight due to regulatory withdrawal rights. And this granular approach actually allows banks to capture the unique liquidity characteristics of each asset and each liability class. For example, I found that aggregating too broadly can mask significant risks, for example, so it's dangerous for the banks. For instance, the behavior of retail deposits under stress can differ dramatically from corporate funding, say. And we to perform the appropriate analysis, we have to separate these kind of things, and therefore we can gain a much clearer picture of our vulnerables. So, continuing the discussion on weekly stress test components. So, the banks therefore usually analyze funds from legal entities, and these funds, for example, can behave differently from retail deposits in a crisis, for sure. State financing here is very crucial, maybe very crucial, and it usually includes funds raised under regulation. In Russia, for example, it will be 312p regulation, and report transactions with the central bank is very crucial as well, and the others, various government deposits, for example. The banks usually examine debt capital market instruments like bonds, commercial paper, and syndicated loans. And many banks, for example, may underestimate the complexity of these funding sources in a crisis, and that might be a problem. For example, I have seen actually many cases where banks assumed government support would always be available, for example, only to face rude weakness when policy priorities shifted. And therefore, the comprehensive approach here helps to avoid such dangerous assumptions. So, when integrating stress testing with business planning, usually we align our analysis with the balance sheet structure projected in various business scenarios. We usually calculate survival horizons for all business plan scenarios, which ensures our liquidity buffer is sufficient for any projected path. And for the ruble stress tests, we usually use the ruble gap. For foreign currency, we aggregate all non-ruble exposures into USD equivalent. And it is very important to note that we exclude payments on overdue loans usually during the stress horizon, because this conservative approach reflects the reality that recoveries often slow dramatically in a crisis. So now let's discuss very shortly how we can calculate our liquidity buffer. First of all, we focus on the free liquidity buffer for survival horizon calculations. This usually excludes unencumbered assets or required reserves, for example. And for the business plan, we usually consider the total buffer, as, for example, the free portion can fluctuate due to central bank operations and reserve requirements. When we stress test ruble liquidity, we usually only include ruble assets or those that can be readily converted to rubles. This table on the slide shows the main components we usually include in our liquidity buffer calculations. Yeah. You should notice how some tools are used differently for overall ruble and foreign currency stress tests, for example, because here the granularity is really vital. For instance, forex swaps here, as you can see in the bottom line, are crucial for currency-specific tests, but they are not relevant for all currency aggregates. Conversely, instruments like 312p regulation funding may be key for ruble liquidity, but not applicable to foreign currency tests. And in my experience, for sure, many banks use a one-size-fits-all approach for liquidity buffers, but the reality that different stresses require different tools actually, because our nuanced method ensures we are prepared for a variety of scenarios. And once again about calculating the survival horizon. So essentially, we are finding the first day where our liquidity buffer turns negative. So this is our survival horizon. This usually tells us how long we can withstand the stress scenario. It's a really simple concept, as I said you, but it is really powerful. That is why it is widely used all over the banking system. And I have found actually that focusing on this single, for example, clear metric helps cut through the complexity of liquidity risk and drive home the urgency of maintaining the adequate buffers. But you should remember, nevertheless, that in crisis, survival is measured in days, because this calculation gives us a tangible sense of our resilience. So, for a more precise calculation with the multi-day periods, we use usually linear interpolation. Because this assumes uniform distribution of outflows within the period, which are really reasonable, which is a really reasonable approximation for most scenarios. And here the formula gives us usually the fractional number of days we can survive within a given period of time. In practice, there is a level of precision to be valuable when comparing different stress scenarios or evaluating the impact of potential management actions, because it allows for more nuanced decision making and close call situations. And finally, here we bring it all together with this formula for the total survival horizon here. Because we assume the full days from preceding periods, then we add the fractional days from our interpolation in the final period, and then we calculate this for each scenario in rubles and foreign currencies, and in all currencies combined. Because this minimum or the minimum of these 9 values, for example, becomes our final survival horizon. And finally, this comprehensive approach ensures that we are considering our weakest point across all scenarios and currency combinations. And as well, also, it's often these specific vulnerables rather than aggregate measures that pose the greatest risk in the crisis. So we have come up to the next question. What is the primary purpose of calculating the survival horizon liquidity stress testing? Please write in your answers in the chat. So let's take a couple of minutes for that. Okay, let's get back. Yeah, quite right. The correct answer is the second. To estimate the time period the bank can meet its obligations during a stress scenario, because a short explanation, because this question tests understanding of the key concept of survival horizon in liquidity stress testing, which, as I said before, is a central theme in the presentation and the lecture. And the correct answer reflects the definition and purpose of the survival horizon, as it was described on the slides, where it's explained as the period during which the bank's liquidity buffer remains positive under, for example, stress conditions. Okay, let's go on. Yeah. Okay, the next topic we will cover on will be devoted to the interest rate risk in the banking book, or IRRBB. So let's dive deeper into this very crucial topic, because it is really important for anyone working in the banking or in the risk management. First of all, it refers to the potential impact of adverse interest rate movements, for example, in the bank's financial conditions, specifically related to assets and liabilities in the banking book. And therefore, understanding and managing this risk is essential for maintaining a bank's profitability and overall financial health. As we'll see, mismanagement of this risk can lead to significant losses. Throughout this part of the lecture, we will explore the various aspects of the interest rate risk in the banking book, including its sources, measurement techniques, management strategies, and I believe that by the end, you will have comprehensive understanding of this crucial or critical risk factor in the banking. So let's start by examining how the bank's business model shapes its balance sheet structure. It's really fundamental to understanding. Take a look at these charts on the slide. So they show the asset and liability distribution for three types of banks: investment, universal, and commercial. You should notice here how the asset mix varies. For example, investment banks have a higher proportion of securities and trading assets, while commercial banks here focus more on loans. And on the liability side, we see differences as well. For example, commercial banks rely heavily on deposits, while investment banks have more diverse funding sources. Why does this matter in terms of the interest rate risk management? Well, the balance sheet structure directly influences a bank's interest rate risk profile because different assets and liabilities have varying sensitivities to interest rate changes. Therefore, the balance sheet structure is very important or crucial. For example, a bank with a large portfolio of fixed rate loans might be more vulnerable to rising interest rates than one with mostly variable rate loans. That is a difference. Now, after we've seen how balance sheet structures differ, let's discuss the risks associated with different parts of the balance sheet. We typically, first of all, divide a bank's activities into two main categories: the banking book and the trading book. And these have distinct characteristics and risk profiles. For example, the banking book contains the bank's core banking activities, like think loans and deposits, and these are usually held to maturity and account for the majority of the typical bank's balance sheet. On the other hand, the trading book includes usually financial instruments held for short-term trading purposes. These are marked to market daily, and they usually represent a smaller portion of the balance sheet. And the key takeaway here is that the nature of these activities leads to different types of risks. For example, the banking book is particularly exposed to interest rate risk, which is our focus today. So understanding these distinctions is really crucial for effective risk management. And here, different risks require different management approaches, as we'll explore further in the lecture. So now let's delve deeper into the differences between the banking book and trading book, because these comparison will help us understand why interest rate risk requires specific attention. First of all, we can look at the income sources. So the banking book, as you can see, generates interest rate and fee income, while the trading book aims to for example, arbitrage profits and revaluation gains. The accounting treatment differs too, because banking book items are often amortized cost, while trading book items are usually marked to market. This really impacts how interest rate changes affect reported earnings of the bank. And then time horizon is another crucial difference because, as you can see, banking book items are typically long-term, sometimes up to 30 years for mortgages, for example, and trading positions are usually short-term, often less than a year. And in overall, these differences lead to distinct risk management approaches. For the banking book, for example, we use techniques like transfer pricing and product management. And for the trading book relies usually more on position limits and market hedging. Let's focus on the specific risks we need to consider in asset and liability management, particularly for the banking book. The three main risks, interest rate risk, liquidity risk here, and forex or currency risk. Today we are focusing on interest rate risk, but it's important to understand how these risks interact between each other. For example, interest rate risk in the banking book is the potential for losses due to adverse interest rate movements, and this can impact both earnings and the economic value of equity of the bank. While liquidity risk relates to the bank's ability to meet its obligations as they come due, and interest rate changes can therefore indirectly affect liquidity, for example, by influencing deposit behavior or, for example, loan prepayments. And currency risk finally becomes relevant for banks with positions in multiple currencies. For example, exchange rate fluctuations can interact with interest rate movements to amplify or to mitigate risk. To prove that, let's look at a historical example that dramatically illustrates the importance of the managing interest rate risks, which is called the savings and loan crisis of the 1980s in the United States. Savings and loan S&L, in short. So before the crisis, S&Ls had a seemingly stable business model, and they took in short-term deposits at fixed rates and made long-term fixed-rate mortgage loans. So it sounds simple. But then came a perfect storm. For example, high inflation led to rapid interest rate increases, and suddenly S&Ls were paying more on deposits than they were earning on their existing mortgage loans. And therefore, the numbers are staggering. For example, more than 1,000 out of 3,000 banking organizations failed in the United States during this period of time. And the total cost to the US economy was around $370 billion overall. And what else? This crisis teaches us a crucial lesson about interest rate risk, because mismatches between the interest rate sensitivities of assets and liabilities can lead to devastating losses when rates, for example, move unfavorably. So now let's discuss one of the key sources of interest rate risk. It's optionality in banking products. The truth is that many banking products have embedded options that can significantly affect their interest rate sensitivity. For example, a common example is the option for early withdrawal on deposits. So if we look at this graph, then we can understand that it shows how optionality can create mismatches between assets and liabilities. Even if the contractual terms seem mismatched, then embedded options can disrupt his balance. For instance, if interest rates rise, depositors might exercise their option to withdraw early and reinvest at higher rates, their deposits. And these can leave the bank with the funding gap. On the asset side, borrowers might prepay fixed rate loans, for example, when rates fall, forcing the bank to reinvest at lower rates. And here, the key takeaway is that optionality adds complexity to interest rate risk management, because we need to model and account for these embedded options to accurately assess and manage risk. So now let's move to another major source of interest rate risk, which is unfavorable changes in the interest rates themselves. And this graph illustrates how a sharp rise in short-term interest rates can impact a bank's position. Here, the red line shows the sudden increase in the rates. And when here short-term rates spike, the cost of funding for the bank increases rapidly, actually. This is particularly problematic if the bank has a large amount of short-term liabilities, say, funding longer-term assets. And in this scenario, the bank's funding costs rise faster than it can reprice its assets, leading to a squeeze on net interest margins and potential losses. And it is important to note here that the impact isn't just on new business, because existing positions on the balance sheet are affected too, but especially those with floating rates or nearing repricing dates are the most vulnerable ones. This actually underscores the need for robust interest rate risk management, because banks need to stress their portfolios against various interest rate scenarios and have strategies in place to mitigate potential losses. So now let's examine another source of interest rate risk, which is the mismatch in base rates between assets and liabilities. So if we look at this example, for example, we have a loan issued at most prime 3 months plus a spread, while the funding may be based on RONIA rate 3 months plus a spread as well. Even here, both rates are 3-month rates. They can move differently. This is what we call a basis risk. For example, if the deposit rate, for example, RONIA 3-month rises more than the loan rate, for example, most prime 3-month, the bank's interest margin gets squeezed, potentially leading to losses. This type of risk can be particularly tricky because it's not just about the level of interest rates, but it's about the relationship between different rates. And overall, managing basis risk usually requires careful monitoring of correlations between different interest rate benchmarks and potentially using hedging strategies to mitigate the risk. So let's recap and expand on what we've covered about interest rate risk so far. So first of all, interest rate risk in the banking book is the potential for changes in interest rates to adversely affect the bank's financial condition. And it's really important to know that this risk accumulates over time. It's not just about immediate losses, but it's long-term impacts. So we can break down interest rate into the several components. Therefore, first, it's curve risk. This usually includes both parallel shifts in the yield curve and changes in the shape, slope, or curvature. And here, different types of curve movements usually can impact different parts of the balance sheet. Then we have basis risk, which we just discussed. So it's about the risk of spreads changing between different interest rate benchmarks. And optionality risk comes from the embedded options in many banking products, like, for example, the right to prepay loans or withdraw deposits earlier. And finally, there is a credit spread risk, which relates to changes in the bank's own borrowing costs relative to market rates. So now let's delve deeper into the concept of embedded options in the banking products, because this is very significant source of interest rate, as I said before, and we have to understand it and manage. First of all, embedded options give customers the right to alter the cash flows of a product. So because these can significantly change the interest rate risk profile of the bank balance sheet, actually. Some common examples of the optionality risk may include early withdrawal of deposits, early repayment of loans, the ability to replenish deposits during their lifetime, the option to draw down a loan at any time, for example, interest rate caps and floors on floating rate products. And these options can be beneficial for customers, but they can create uncertainty for the bank, for example. For instance, if rates rise, depositors might withdraw early to seek early or higher yields elsewhere, create a liquidity strain. So on the asset side, borrowers might prepay fixed rate loans when, for example, rates fall, forcing the banks to reinvest at lower rates. And the key challenge here is to model these behavioral aspects accurately, because we need to estimate how customers might use these options under different interest rate scenarios. Therefore, and these often involve sophisticated modeling techniques, and it usually requires a deep understanding of customers' behavior and market dynamics. So now that we understand the sources of interest rate risk, so let's discuss how we can measure it. So there are two main approaches to measuring interest rate risk, actually. It's earnings sensitivity and economic value sensitivity. So the earnings approach typically focuses on net interest income, or NII, and its sensitivity, and it looks like at how interest rate changes might affect the bank's profitability over a specific time horizon, usually, for example, 1 year. So therefore, the economic value approach, often called economic value of equity, or EV, it considers usually the change in the present value of all future cash flows if interest rates change. And here, both methods are important and provide different insights. For example, NII sensitivity gives us a short-term view of potential earnings impact, while EV, for example, provides a long-term perspective on the bank's value. But in practice, many banks use both measures. They might set limits on NII sensitivity for short-term risk management and use, for example, EV for long-term capital planning. And it's worth noting here that regulators are increasingly focusing on standardized interest rate risk management measures. For example, the Basel Committee, for instance, has proposed standardized frameworks for both earnings and economic value approaches. So the next slide will be devoted to the economic value of equity measurement. So let's take a closer look at it. So in general, EV is essentially the difference between the present value of all future asset cash flows and the present value of all future liability cash flows. And here on the slide, the diagram shows the process of calculating EV. For example, first of all, we project all future cash flows from assets and liabilities. And this usually includes both principal and interest rate payments. Then we discount these cash flows using an appropriate interest rate curve, because this gives out the present value of each cash flow, as you can see. And finally, we sum up all of the discounted cash flows for assets and liabilities separately and take the difference between them. And this difference is called an EV, economic value of equity. And the key insight from EV is that it gives us a comprehensive view on how interest rate changes might affect the bank's long-term value. For example, if interest rates change, it will affect the present value of these cash flows. Generally, when rates rise, for example, EV tends to fall and vice versa. But the exact impact depends on the balance sheet structure. And EV is particularly useful for assessing the risk of long-term fixed rate positions that might not show up in short-term earnings measurements. But however, it is important to know that EV is a rather theoretical measure because it assumes the bank is wound up immediately, which is typically the case in practice. Isn't typically the case of practice. So now let's discuss a crucial aspect of interest rate risk measurement, how we define interest rate repricing maturities. So in general, there are three approaches. First one, contractual repricing. This is the simplest approach where we use the contractual terms of each product to determine when interest rates will change. Then static behavioral adjustments. Here, we adjust the contractual terms based on the observed customer behavior. For example, we might assume some early repayments of loans based on historical averages. Then goes dynamic behavioral adjustments, and this is the most sophisticated approach, actually, when we model how customer behavior might change in response to interest rate movements. And the contractual approach here shows all repricing at maturity. The static behavioral approach spreads it out based on the average behavior, and the dynamic approach shows how behavior might change if interest rates fall, for example. And for sure, each approach has its pros and cons. For example, contractual is simple but may not reflect reality, while dynamic is more realistic but also more complex and model dependent. But in practice, many banks use a combination of these approaches, applying more sophisticated models on their largest and more behaviorally sensitive portfolios. So the next slide. Let's consider here another important aspect of the interest rate risk measurement, how we project the balance sheet into the future. So there are four main approaches, each with increasing complexity. First of all, retiring balance sheet, which assumes no new business. Here, the balance sheet simply runs off according to contractual maturities. So you can see it in the green color on the graph. Then goes constant balance sheet. So where we assume maturing positions are replaced with similar new business. For example, keeping the overall balance sheet size and composition stable. Then partially dynamic projection. So this incorporates new business plans, but doesn't account for how this might change with market conditions, for example. Then fully dynamic projection, the most complex approach here, because it models how both new business and balance sheet composition might change under different scenarios. And we have to look at the diagram here. You can see here how this approach has led to different projections of balance sheet size over time. So the choice of approach depends actually on the bank's needs and capabilities. Simpler approaches are easier to implement and explain, but they may miss important dynamics. More dynamic approaches can provide richer insights, but they are also more complex and model dependent, therefore. And also, they require assumptions about future business strategies and market conditions as well. And in practice, many banks use multiple approaches, actually. So let's conclude our discussion by examining three key approaches for modeling interest rate and foreign exchange risk: scenario analysis, parametric analysis, and simulation analysis. Here you can see that scenario analysis is the simplest approach because we select a small number of specific scenarios, which are often based on expert judgment or historical events. For example, we might model a 200 basis point parallel shift in the yield curve, as suggested by the Basel guidelines. Parametric analysis is more statistically driven because we use historical data to estimate the parameters of probability distributions, for example, for interest rate and exchange rate changes. And then we can calculate risk measures based on these distributions. For example, we might use the 99% point, say 81% quantile of the normal distribution for exchange rate changes. And the final one, simulation analysis, is the most comprehensive approach, where we generate a large number of possible scenarios, either through historical simulation or Monte Carlo methods. And this allows us to capture complex nonlinear relationships and interactions between risk factors. So, and all of these scenarios have its strengths and their strengths and weaknesses. For example, scenario analysis is easy to understand and communicate, but may miss important risks. While parametric analysis provides a statistical foundation, but assumes rates follow specific distributions. And finally, simulation analysis can capture complex dynamics, but the shortcoming of this analysis, it's computationally intense, that it is computationally intensive and can be a black box. So we have come up to the next question. Please take a couple of minutes to answer it and to write down your answers in the chat. So the question is, which of the following is not a component of interest rate risk in the banking book as mentioned in the lecture? Please write your answers into the chat. Okay, let's go on. Yeah, you are quite right. So the right answer is 4, because in the presentation of the lecture, we identified curve risk, basis risk, and optionality risk as components of interest rate risk, but we did not mention volatility risk as a specific component. So because for sure, volatility risk is more commonly associated with the trading book in its activities rather than banking book interest rate risk. Therefore, you're quite right. Thank you very much. We will go on. So let's go through the gap analysis and duration-based approaches, which are really fundamental techniques used by banks and financial institutions to measure and manage the exposure to interest rate risk. So first of all, let's talk about the concept of repricing, which is really crucial in understanding interest rate risk because it's the time after which the interest rate on a position will change. And it is important to note here that the repricing maturity can differ significantly from the remaining maturity of the instrument. So if you look at these graphs, they show the difference between a 3-year fixed rate loan and a 3-year variable rate loan. And for the fixed rate loan, for example, the interest payment remain constant regardless of market rate changes, and the repricing maturity is the full 3 years. In contrast, for the variable rate loan, the interest rate here changes over 3 months based on a reference rate, and the repricing maturity will be just 3 months. So the difference in repricing periods is very crucial, and it is what creates interest rate risk for the bank. It's why we need to carefully analyze the pricing structure of our balance sheet. So Now, a few words about the interest rate gap. This is a really key metric in measuring interest rate risk, as we understand. So, simply put, it's the difference between assets and liabilities that reprice within the given time interval. So, and we can calculate this gap for each major currency in which the bank operates. And a major currency is typically one of the that exceeds 5 or about 5% of the balance sheet total. And here on the graph, the black line shows the cumulative gap, which is really the running total of these gaps over time. So now let's discuss how banks make money through maturity transformation. So if you look at these graphs, they show us how banks typically have shorter-term liabilities like deposits and longer-term liabilities like loans, for example. And this mismatch is intentional because banks borrow at lower short-term rates and lend at higher long-term rates. And the difference is their net interest income. But there is a catch, actually, because when interest rates rise rapidly, this strategy can backfire. If we look at the right side of the slide, so when rates rise, liabilities reprice faster than assets, and short-term funding costs increase, but simultaneously, income from long-term fixed-rate assets doesn't change. And this squeeze on the interest margin in the essence of interest rate risk. So now let's talk about the concrete example of how interest rate risk manifests. Imagine, for example, a bank with the 100 million ruble loan at a fixed 10% for 5 years, funded by a 100 million ruble deposit that reprices every 3 months. Initially, this looks great because the bank is earning a 5% spread, which is 10% on the loan minus 5% on the deposit. For example, we can watch what happens when the market rates rise over the year, as shown on the graph. Now, the loan rates, therefore, stays fixed at 10%, but the deposit rate keeps increasing each quarter. And by the fourth quarter, the deposit rate has risen to 12%, exceeding the loan rate even. And this flips our 5% positive spread into a 2% negative spread. So the bank is now losing money on this position. And this example obviously illustrates why we need to carefully manage the repricing mismatch between assets and liabilities. So now let us consider the how interest rate changes affect the bank's net interest income, or NII. So let's consider a simple balance sheet: a 100 million loan at 10% and a 100 million deposit at 5%, both for 1 year. Initially, for example, the NII is 5 million, or 10 million interest income minus 5 million interest expense. And now suppose rates increase by 1% after 3 months. So for example, the deposit rate jumps to 6%, but the loan rate stays at 10%. And for the remaining 9 months, our NII drops. And we can calculate is that, for example, 0.75 100 multiplied by 10% minus 100 multiplied by 6% equals to 3 million. And adding this to the NII, for example, from the first 3 months, we can get total NII of 4.25 million for the year. So, and the change is in NII here is minus 0.75 million rubles, because this matches our gap analysis. And this example, in general, shows how we can use gap analysis to predict changes in NII due to the interest rate movements, for example. Here are the general formulas for these calculations. For example, the interest rate gap for a given time bucket is simply the difference between rate-sensitive assets and rate-sensitive liabilities in the bucket. When rates change, the impact of NII can be approximately by multiplying the gap by the rate change and the time remaining in the year. So if we look at the formula, for example, the change in NII equals to the gap multiplied by the change of R and multiplied by the residual period of time, because this gives us the change in AII for each time bucket. And to get the total impact, we assume this across all time buckets. So the next slide here shows a real-world example of the interest rate gap analysis for the bank, because now the bar chart here represents the gap between rate-sensitive assets and liabilities across different time buckets. And positive bars indicate more assets than liabilities repricing in that period, and negative bars indicate the opposite. So we can notice here the large positive gap into the up to 3 months bucket, which actually suggests that the bank is positioned to benefit from rising rates in the short term. However, if we look at the negative gaps in the longer term buckets, so they indicate potential vulnerability of the bank to rising rates over the longer term. And the line graph here shows the cumulative gap. So, and this gap also shows a real-world example of an interest rate gap analysis for a bank, because the bar chart represents the gap between rate-sensitive assets and liabilities across different time buckets. And here, positive bars indicate more assets than liabilities repricing in the period, and negative bars indicate the opposite here. So now let's talk about the key metric derived from gap analysis, which is net interest income sensitivity. So net interest income sensitivity tells us in general how much our net interest income will change for a given change in interest rates. If we look on the graph, so the x-axis shows interest rates, while y-axis shows NII, net interest income. And the slope of the line is our NII sensitivity. As steeper, a slope means higher sensitivity. Small rate changes lead to big NII changes. And here we typically express the change in NII for a 1 percentage point increase in rates. For example, our NII sensitivity is 50 million rubles, and that means a 1% rate increase would boost our annual NII by 50 million rubles. Not 50, sorry. No, 50 million rubles. So let's work through a practical example of calculating NII sensitivity. So we start with our gap profile across different time buckets as shown on the table, on the graph here. And for each bucket, we multiply the gap by the fraction of a year remaining at the assumed rate change, for example, 1% in this case. For instance, in the bucket of 6 months to 1 year, we have a minus 1.4 trillion gap. Multiplying by 10 divided by 12, as 10 months remain in the year, and 1%, we get minus 11.7 billion. Then we assume this impact across all buckets. And in this case, it totals into 17.9 billion rubles. This means a 1% parallel increase in rates would increase our annual NII by 17.9 billion rubles. And it is important actually to know that this is a simplified calculation, because in practice, we might use more sophisticated model that account for yield curve changes and customer behavior as well. So now let's discuss a common feature that complicates our interest rate risk analysis as early repayment options on loans. Let's consider a scenario where we have discussed a loan, or we have issued a loan at 7% funded by the liability at 6%. So if rates fall and the borrower exercises their option to repay early, so we lose that positive 1% spread for the remaining term of the loan. So, and the impact here on NII is negative, because 6% minus 7% multiplied by the contract term minus actual term will be less than 0. So this optionality introduces what we call negative convexity, which is very relative to our balance sheet, to the balance sheet of the bank. So it means that as rates fall, not only do we earn less on our existing loans, but we might lose some of those loans altogether. And this risk particularly pronounced in markets with active mortgage refinancing. For example, in my experience, banks, they don't properly account for this risk and significantly overestimate their NII in falling rates scenarios. So now let's consider the opposite scenario, early withdrawal options on deposits. First of all, imagine we have a deposit paying 6%, which is funding a loan earning 7%. If rates rise significantly, then depositors might access their option to withdraw early and reinvest at higher rates. And we are then forced to replace that funding at the new higher market rates for sure. Again, the impact on net interest income is negative. For example, 6% minus 7% here, multiplied by the contract term minus actual term, is less than 0. This is another form of optionality that introduces complexity into our interest rate risk management, because it's particularly relevant in a rising rate environment and can lead to significant liquidity pressures. So, and now let's discuss the subtle but important concept, which is basis risk. Once again, so because as I said before, so even if the tenors of our assets and liabilities match perfectly, we can still be exposed to interest rate risk because of the different interest rate risk benchmarks, as you can see here on the graph. So, and let's conclude with a stark illustration of how basis risk can impact on the bank's profitability. For example, we can consider two scenarios, both with perfectly matched tenors for assets and liabilities. And in the first scenario, we have a floating rate assets at 9% and the non-interest bearing liability. And our net interest income margin is healthy 9%, for example. In the second scenario, we again have an asset yielding 9%, but now our liability cost is 8%. So our margin has shrunk to just 1%. And overall, in general, these dramatic differences in profitability occurs despite having no traditional interest rate gap, for example, even. So the next question is, what is the primary reason why the coincidence of tenor between assets and liabilities does not guarantee the absence of interest rate risk? Please take a couple of minutes to write your answers into the chat. Okay, let's get back. So yeah, the right answer is 3. So you're quite right. Let's go on. So, and the final theoretical topic within the lecture will be asset liability management strategies. As you can see in this slide, the banks essentially have three main approaches to ILM asset liability management strategy. On the one end of the spectrum, we have banks focused, for example, on minimizing volatility, and these institutions prioritize stability over maximizing profits. Then, in the middle, we have banks that aim to risk-return optimization, because this balanced approach seeks to maximize returns while keeping risk within acceptable limits. And at the other end, we have banks focused on maximizing profits. And these institutions are willing to take on more risk for potentially higher returns. And this choice, usually between the strategies, isn't arbitrary, I would say, because it's based on several key factors. First, the bank's required interest income. How much do they need to earn to meet their financial goals? Second, the bank's risk appetite. How much volatility are they willing to accept? And third, market specifics and the structure of the bank's balance sheet and product matters. So therefore, let's dive deeper into the specific objectives of interest rate risk management here. The first objective we see here is closing an interest rate position. This involves reducing or completely eliminating exposure to interest rate changes. And next, we have optimizing risk return. And this aligns with the balanced approach we discussed earlier. And the third objective is maximizing income through the transformation of tenors, which involves usually taking advantage of the yield curve to increase profits. And finally, we have monitoring interest rate risk, and which is really crucial regardless of which strategy a bank chooses. Let us consider one of the real-world examples to illustrate these approaches. For example, closing position, interest rate position is common in countries with low interest rates and flat yield curves. For example, you'll see this in Europe with banks like Deutsche Bank and Commerzbank, for example. Tenor transformation is popular in countries usually with steep yield curves like Brazil. For example, here Banco do Brasil is a good example of this approach. And the choice of objective depends on market conditions for sure, and regulatory requirements and the bank's own capabilities. So now let's have a look at the toolkit banks use to manage interest rate risks. First, we have transfer pricing, because this involves actually calculating an internal interest curve based on market rates, and it is usually a powerful tool for incentivizing business units to align with the bank's overall risk strategy. And then product structure management is another key tool. For example, by changing the features of their products, banks can limit their exposure to interest rate risk. And then setting limits for business units helps ensure that new transactions contribute to the desired risk profile. Hedging and derivatives also is a common practice to reduce sensitivity to interest rate changes. Top-level limits act as a final check, for example, to ensure the key metrics that the key metrics align with the target profile. So this is an example of interest rate position management. So in this scenario, we start with a bank that has a significant interest rate gap, and you can see here this is represented by the blue bars, green bars on the chart. So, and the initial sensitivity of the bank's net interest income to a 1 percentage point increase in rates is here for about 600,000 rubles. This is really quite significant. But now, what happens when we apply some asset liability management strategies, for example, by managing the product structure, specifically shifting some loans to floating rates, we can dramatically reduce this sensibility. And after these new transactions, the sensitivity of net interest income, for example, drops to zero, which means the bank's income is now much more stable in the face of interest rate changes. So, and now let's look at another approach to managing interest rate risk, like using derivatives, specifically interest rate swaps. In this example, we can start with the same initial position as before, with the sensitivity to the 1 percentage point rate change. But instead of changing product structures, as for the previous example, we are using an interest rate swap to hedge the risk. As you can see here in the diagram, we are using the swap to effectively convert our floating rate exposure to fixed rate. So what is the result here? So we can again reduce our sensibility to zero. And this is a very key advantage of using derivatives for hedging, but just in case that the hedging derivatives markets is liquid enough. So, and we can see here the measures to reduce the interest rate gap significantly decrease, which aims to decrease in volatility of the bank's net interest income. And now a few words about inverted positions here. Look at the chart of the slide, and we have an interest rate gap that's not just risky, but actually loses money for the bank. In this example, for example, we are losing 2% on a position of 1 million rubles. That's a significant hit to profitability. And these inverted positions often arise from maturity mismatches between assets and liabilities. For instance, we might be funding long-term, low-rate loans with short-term, high-rate deposits. And so here is an example. So what are the measures to reduce the risk of built-in optionality there? Therefore, so as you can see from this slide, managing interest rate risk isn't just about dealing with the linear gap, as we discussed before, but we also need to consider the risk from embedded options in our products. So what do I mean by embedded options? So these are features in our products that give customers the right to change the time or amount of cash flows. So, and as you understand, common examples include the right to prepay the loan or withdraw a deposit earlier. And for example, if we look at the graphs on this slide, so the area represents the linear interest rate risk we've been discussing before. But notice the red area here. So that's the additional risk from embedded optionality. And we can reduce this optionality, for example, by means of the hedging techniques. Finally, as you can see in this diagram, when we extend a credit line, for example, to a corporate client, we are essentially giving them an option. So they have the right, in other words, but not the obligation to draw down the full amount of the loan. And this optionality creates risk for the bank as well, because if rates rise, the client is likely to draw down the loan at the previously agreed lower rate. And the bank then start funding this loan at higher market rate, for example, squeezing its margin. And conversely, if rates fall, the client might choose not to use the credit line at all, and leaving us, for example, as a bank with unutilized funds that we could have invested more profitably elsewhere. So, and this asymmetry where the bank tends to lose in both rising and falling rate scenarios is a classic feature of embedded options, in other words. And here is an example, the example of the repayment on a corporate loan, which is brings the optionality to our balance sheet as well. So what are the general measures to reduce optionality? First of all, we may increase fees for early loan repayment. By setting these fees at around, for example, 4% per annum, the bank can maintain a high rate on its loan portfolio even when market rates fall. Next, the bank can limit the timing of rate fixing to just 2 weeks, for example, which reduces its exposure to rising rates between when a loan is approved and when it's actually drawn down. For example, the bank may reduce open credit card limits by 50%, which might seem drastic, but it can be effective in maintaining profitability in a low rate environment, for example. And it also reduces the cost on maintaining liquidity buffers for unused limits. And for deposits, for example, tighten the terms of early withdrawal can help the bank maintain its margins when rates are rising. And each of these measures has its pros and cons. For example, higher prepayment fees might reduce early repayments, but could also make the bank's loans less attractive to some borrowers, for example. And shorter rate fixing periods, for example, may protect the bank, but shift interest rate risk to the customer. So, and therefore, reducing these credit limits, for example, might impact customer satisfaction and potentially reduce future lending opportunities. And the key here is to implement these measures thoughtfully. For example, considering both risk management and customer relations aspects. So, and now we have come on to the final question of today's lecture. So, which is which of the following is not a common objective of interest rate risk management in banking? So please take your time to answer in the chat. Please put your answers in the chat. Take a couple of minutes for that. Okay, yeah, quite right as well. The right answer is 3. Increasing exposure to interest rate fluctuations. Yeah, and because the lecture slides outline various objectives of interest rate risk management, including closing interest positions, for example, maximizing income through tenor transformation, optimizing the risk return profile. But however, increasing exposure to interest rate fluctuations is not typically an objective of risk management. You're quite right. So here you can see the description of the case as may be called, for example, smart treasury or smart asset and liability manager. So therefore, what is it about actually? This is a model of the real working bank, but not the overall bank, but some part of it devoted to the treasury operations. Therefore, our purpose in this practical task is to manage assets and liabilities of the bank by means of managing different parts of the risk. So here you can see interest risk, currency, liquidity, and capital adequacy. Therefore, all of these risks have some kind of limitations. And therefore, we have to be in these limits. Simultaneously aiming to the target of the ALM management, as for example, revenue of the bank or profitability of the bank or bank's margin. Therefore, we have the initial balance sheet of the bank here, and you can see here different aggregated balance sheet items like cash, like nostro accounts due to the banks, accounts due to the banks, like loans to the banks and so on, available for sale securities portfolio, loans to legal entities in different currencies, and loans, consumer loans, and housing loans or mortgages, and liabilities or passives, the passive side of the balance sheet. It's funds from the Bank of Russia, deposits to legal entities, of legal entities, term deposits of individuals, current accounts of individuals, and therefore bonds issued, for example, subordinated loan, and own funds or capital. And therefore, we can see here the yield curves in different currencies as well. First of all, in rubles and foreign currencies. So for different terms, what is a yield curve? As you can remember, it's a relation of the term of the funds allocation to the interest rates of this funds allocation. And therefore, we have, or we might have a liquidity problem when allocating our funds as a bank, for example, and we have some benefit or gain for liquidity or the liquidity spread, therefore, which is being added to the proper interest rates for the proper term. And in our modeled example, so one foreign currency is equal to the one ruble. So, and we have several analytical sheets here. First of all, our initial balance sheet in different dimensions, I will say. So what we can see here, first of all, the same balance sheet items, currency of these balance sheet items, term of funding and allocation. So here's a term of allocation, and here's the term of funding. Then volume of allocation and funding, interest rate, and cost of funding with the liquidity spread. And therefore, we are able to calculate the margin rate for each balance sheet item. So, and cost of capital and cost of credit risk as well, and economic value added here. So, thanks to these issues, we can estimate the profitability of different balance sheet items in this case. And here you can see that we can get losses on the cash allocation because it doesn't pay interest. Therefore, nostro allocation as well, because it doesn't pay either it doesn't pay interest or it does not have any interest at all. And loans to banks, for example, because it's a flow margin as well. And the most marginal item is consumer loans. Yeah, and the second is loan to legal entities, for example, in this example. But for the same time, we can calculate the margin for the liabilities items. So because they are also marginal, but their margin, as you may remember from the previous lecture, is calculated due to the spread or due to the difference between real interest rate for this funding, for example, and the so-called FTP curve, funds transfer pricing curve. This is an internal yield curve within the bank, which is, in this case, which is equal to that one. So, which indicates the benchmark yield for each item, and therefore, the more the difference between real interest rates for the funding and the FTP yield curve, the more marginal this item is. Therefore, this may play as some kind of the stimulation factor for the funding divisions, for example, of the banks. And here we can see the same table, but after the measures done by the treasurer, for example, after the measures. Therefore, we can see further on that after we change something, for example, in terms of interest rates or in terms of volumes, then we will see that the margin or these figures will change as well. So this is about the marginality of our business. What is our purpose here? Our purpose is to make our margin maximal, for sure. But the problem is our limitations, the limitations for different kinds of risks, and the limitation for the capital adequacy. So we cannot move our margin to the maximal levels because in this case, our limitations with our limits for different risks might be exceeded, and this is a trade-off. Then we can see the breakdown of these balance sheet items into the different lines of business, like retail business, corporate business, for example, internal bank. Internal bank, as you can remember, this is a part of the funds transfer pricing system within the bank. This is a bank within the bank, in other words, and therefore you can see here that the bank is usually has losses. Why? Because the main purpose of the internal bank is to manage interest rate, liquidity, and currency risk in these terms, and therefore it has to take these kind of risks on itself, and it is being paid for that, for these operations by the funding and allocation divisions. But initially, it has losses. Therefore, this is an overall banking figures of profitability. Therefore, here you can see that, for example, of business lines like retail business or corporate business, they are generally profitable, but simultaneously, an internal bank has losses. Therefore, in these business units, business lines, they pay to the internal bank the compensation of these losses, actually. And there is a very interesting case, for example, for Sberbank. If you can remember of, say, 2014, there was a huge liquidity squeeze, and for some period of time, and therefore, at the end of the 2014, the Sberbank was profitable, for sure, but there was a huge deficit or the huge loss for the internal bank of Sberbank for about several hundreds billion rubles. Yeah. 340 billion rubles. Nevertheless, overall, the bank was profitable. So therefore, that is due to the realization of interest rate risk and liquidity risk. And this is the second table after the measures done. And this is particular analytics to the different kinds of risk. This is interest rate risk analytics. You can see here the analysis of gaps, interest rate gaps. And here you can see the analysis of the sensitivity. First of all, sensitivity on the horizon of 1 year. You can see here that the amount of funds allocated after 1 year is more than amount of funds allocated before 1 year term. Therefore, we have a minus sensitivity. What does it mean? That means that if the rates or yield curve rate, interest rate curve increases, there is a parallel increase of interest rate risk, then the bank's net interest income will be negative. So due to this structure of interest rate gap. Therefore, so this is for about interest rate risk costs for about 2% share of capital. This is about the capital allocation of risk or economic capital. This is a sensitivity limit, so therefore you can see that this is an absolute value, therefore you can see that we are within the limit here. There is nothing to worry about yet. And this is in rubles. And this is this interest rate position, interest rate gap in foreign currency. And you can see the opposite situation here. The sensitivity on the horizon of 1 year is positive. Therefore, you can see that the gap before 1 year is something equal or bigger to the gap after 1 year. And therefore, why the sensitivity is positive here? Because the weight of this term is less than the weight of this term. So in terms of the sensitivity analysis, and therefore the sensitivity here is positive, and the situation is opposite to the previous one. For example, if interest rate yield increases, shifts parallel, then the interest income of the bank will increase, therefore. And vice versa, if yield curve risk decreases, then the net interest income of the bank increases, therefore. And share of capital is equal to 1.5%. Sensitivity limited. Here you can see that we have exceeded the limits. So therefore, we have to perform some kind of measures to be in the limit here. And how we can do that? For example, we can decrease the gap after 1 year and increase, we have to decrease the gap of 1 year and increase the gap or after 1 year, make it more positive or less negative. Yeah. And here we can see the same, but after the measures performed. So we can see, for example, that here the figures changed. And this is term sheet for the currency risk. You can see here that we have value of the open currency position minus 20. That means that when the interest foreign currency increases, then interest income then net income of the bank decreases. And vice versa, when foreign currency decreases, then net income of the bank increases. Therefore, this is called a short currency position. And this is after the measure is done. So we can see that here our open currency position is within the limit. And this is for liquidity risk. So as we discussed during the lecture, here are several indicators of the liquidity. First one is a loans to deposits ratio. So this is the overall amount of loans, the relation of the overall amounts of loans to the overall amount of deposits. So the bigger this ratio is, the less is level of liquidity of the bank. And here we can see that this ratio is more than 100% with a limit of 109, and therefore it is within the limit. The next is net stable funding ratio, which has to be more than the limit level, more than 100%. And we are within the limits as well. And here is liquidity coverage ratio. And it is has to be more than 100% as well. And it is within the limit. And here we can see where our possible limit gaps are originating. And therefore, we can see here the figures after the measures. And the final analytical sheet is about capital adequacy. We can see here several indicators, like, for example, capital at risk. It's an economic capital to the regulated capital. So, and the meaning is has to be more than the limit, more than 12%. So the limit is breached initially. And here is the leverage ratio. The leverage ratio, it is in the limits, within the limits. So, and here we have the balance sheet devoted to the management measures. So we can hear here the initial figures overall for operating income, for interest rate risk, currency risk, and liquidity risk, and capital adequacy. And therefore, we have to do the following here. First of all, we have to adjust interest rate rates for different balance sheet items and volumes for the others, such way that our operational income of the bank would be maximal within the following limitations. So the limitations before the measures are here, and the limitations after the measures are here. So therefore, we can see that not all of the limits are within nominal values. So here, for example, we can what we can do. So what is the first problem, for example, in terms of the currency risk? We can see here the limitation for the currency risk, which is 2. Initially, we have 15 and exceeded positive currency position. And here, after the measures, we can see a huge negative currency, open currency position. But it must be within this limit in absolute values. Therefore, what we can do, how do you think, or what we should do? You can answer in the chat, or you can do it by voice. So we can adjust interest rates for these balance sheet items, and volumes for the others. And we have off-balance sheet part with the derivatives. So we can hedge our positions with derivatives. Okay, for example, first of all, we have to reduce the gap. The gap open currency position in the foreign currency. So and reduce balance sheet items in foreign currency, for example. Which balance sheet items are in the foreign currency? For example, loans to legal entities. So it is in foreign currencies. Therefore, what we can do for that purpose, we can decrease interest rate risk for this foreign currency item, therefore make it less attractive to the business units. And we can see, for example, the current volume of the loans to the legal entities 15. Therefore, if we reduce the interest rate risk, we can see that the volume of the loans in foreign currency decreases as well. And what we can see increase actually, take into account measures, without and with. So the right column is with or after the management features, management measures. For example, currency volume. So it is increases. So there might be some problem because it must actually decrease if we increase the interest rate risk, but it forms different. So there might be some bug. I don't know, but nevertheless. So if we then we have to decrease, for example, the volume of the funding in foreign currencies and increase the volume of funding in rubles. So what else we can do? For example, we can adjust this open currency position with the interest rates. For example, we have currency swaps or currency forwards here. So we can sell, for example, currency forwards and therefore decrease our open currency position. So this is within the limit now. So it seems to me that this acts improperly, maybe some bug. I don't know, but nevertheless, so by these measures, we can adjust our limitations and utilization of the limits of the different kinds of risks. Therefore,